they were wrong in 2008 when they said the subprime crisis was contained and a few days later it blew up. They were wrong when they said there was no inflation and then it was transitory and then it was structural and then it was on its way down and now we've engineered a soft landing. They lie continuously. And I think that people need to understand that this is not a country that inspires confidence. And I think the big money around the world understands that. And this is why you are seeing them sell bonds and buy gold, because it is wealth.
This is Kaiser Johnson with Liberty and Finance. And these are the Miles Franklin weekly specials for January 8th through January 15th, 2024, while supplies last. First this week, we feature backdated 1/4 ounce gold eagles at just $65 over melt. Next, the Armenian 1 ounce silver Noah's Ark coin is $3.49 over spot. And finally, we have a very limited quantity of 1 ounce silver Trump Wanted bars at $3.15 over spot. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you. Welcome back to Liberty and Finance. We're always privileged to have this widely followed returning guest. Andy Schectman is the CEO of Miles Franklin Precious Metals, and he joins us this Tuesday, January 9th, 2024. Andy, thanks for coming back on Liberty and Finance.
Good to be here, my man. Happy to see you again. Thanks for having me.
Yes, I'm still not in my normal office because we are still traveling, having visited for the birth of our granddaughter, and what a blessing. And
congratulations.
Grateful for your presence here for our weekly market update. One phenomenon that was came out in a reminder, I guess you'd call that, news story, was about the remarkable performance of gold versus all other commodities. And actually it came out on top for a long view for the last, since the beginning of this century, of an average gain every year. I think you're going to talk to us about that. And I'm going to post a chart. I'll pull it up in a minute here about that. But when people look at reasons, it's so unfamiliar to most. They're getting advice from the mainstream media that says it's a barbarous relic, it's antiquated, it can't handle anything, the transactions, blah, blah, blah. In the current modern world, it has no place in the modern world of our finances. Then they're hearing from their financial advisors, just buy and hold stocks and bonds and you'll be fine. And then they hear from their families and friends and coworkers, basically rehashing those two same things because everybody's drinking the same Kool-Aid. But meanwhile, quietly, gold just marches on, protecting people from the destructive effects of inflation on their earnings, their savings, and their retirement. Can you talk to us about what we know about the role that gold is playing and always has played, but how the evidence, the data points right now to how it's been behaving for the past 2+ decades?
Yeah, and it's remarkable when you look at it in that light. The public in this country is too obsessed with instant gratification, and that's not even fast enough. And, you know, over the last decade nearly, or yeah, I guess you could say roughly the last decade, where cryptocurrencies have shown us the power of rapid appreciation, where suppressed interest rates, and really when we talk about suppression, to me, it's all about interest rates, which have created an illusion of prosperity in this country for years, where suppressing interest rates and then throwing massive amounts of money over the last few years, which we'll talk about in a moment, has created distortions in asset prices. They don't behave the way they have over the last several years. My mentor, Richard Russell, used to say, if you make 7% per year, you are a rock star. Well, the S&P 500 since the beginning of the century has averaged 7% per year, though I guess if you've been in an index fund just sitting there in the S&P, you are performing like a rock star. But lo and behold, the tortoise in this race, gold, has produced a 7.8% return, annual return, since the beginning of the century. And when you add into it, Dunnigan, the central bank and commercial bank suppression of the market, when you add into it the massive amount of money creation over the last several years, the Western market monetary expansion, massive. I think gold is well below where it should be, yet it continues to hold its own from a standpoint of value appreciation. And, you know, if you look at, for example, in 2020, gold was $17.73 an ounce average price. In 2021, that number was $17.98. In 2022, that number was $18.01. And in 2023, that number is 1943. We continue to see it holding its own. And those numbers right there, especially the last two, where it goes from 1801 to 1943 in 2022 and 2023 as an average price, comes in what is thought to be the worst environment for gold as of rising real interest rates. And so it held its own, very, 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 very much held its own. And, when you look at it from the perspective that Rick Rule always talks about, that 0.5% allocation in this country owns any metal, and he's talking on a broad spectrum from the Harvard Endowment Fund to Joe Sixpack, as he always says, the fact that it has held its own and quietly appreciated, even in the face of rising interest rates, what happens when we pivot and go the other way. Another proxy to look for, I think, when we talk about, or to look at when we talk about just the kind of investment demand that could really propel things higher, is when we take the market capitalization of the S&P 500, all the market capitalization, and compare it to the market capitalization of GLD and IAU, the big Western ETFs. The market capitalization of the S&P 500 of the S&P 500 companies total is about $4.261 trillion. I think I'm right on that. It's about right. I think. The way that I wrote it down was 42,616 billion. So would that be? I think that would be 4,261.6 trillion. Anyways, point of it is that when you compare that to the market capitalization of GLD and IAU, which has a cap of 85 billion, that works out to 0.02%. So whether you're talking 0.5% of people owning it, or look at the capitalization of all the gold ETFs versus the S&P 500, in any respect, they are for all intent and purposes effectively zero. And so if the public wakes up and shifts just a few tenths of 1% of their allocation that was going into bonds, into precious metals, or into equities that were going into precious metals, it will, I think, you create a massive breakout in the price of gold in terms of its investment demand. But look, one of the things that I get pushback on when talking about the BRICS and their attempts to make a settlement currency, which is not the same thing as a reserve currency, is that, well, how could anyone ever, where could a reserve currency ever come from where the bond market would inspire the confidence the way the United States bond market has, which for years has been the most liquid and safe, stable market? Well, I mean, the first pushback would be after 45 years in 2023, the 10-year Treasury had greater volatility than the price of gold. Why? Because I think a good portion of the world sees what we just talked about. Little growth every single year with great liquidity. Well, isn't that supposedly what the bond market is? And from a historical context, holding government's debt as an asset, it has a very short history in a broader perspective. And especially a government that is going to be issuing $1 trillion in treasury bonds every single quarter, a government that is choosing inflation over austerity, a government who has let rates rise 11 straight times, destroying the value of those bonds in circulation, and now is talking about going the other way. This volatility, the mismanagement of the world reserve currency, the way that we have squandered our image on the stage, the world stage. We talk about this every day. And I think we've lost a good deal of that confidence in the rest of the world has in us. And so what I'm getting at is that when you see China and Japan and Saudi Arabia and Russia and all of these countries shed U.S. treasuries, what are they doing with their excess reserves? They're buying gold. And that's why you see over the last 2 years, the central banks buying more gold than at any time in human history. And if we look at the performance over the last 2 years, what did I say it was? It was 1801 average price in 2022, 1943 in 2023. You go back over the beginning of the century, a 7.8% annual return not only beats the S&P, but destroys the bond market. So maybe they're taking a step back and saying, maybe we just load up on gold because that pretty well acts just like a bond. In fact, it's outperformed it. It has greater or lesser volatility right now. And we don't have to rely upon the honesty and the transparency of the West. In fact, there's no counterparty risk. We can hold it ourselves. And so when you realize this transformation of, I think, of attitude and of reality, where gold is holding its own, but I think it's actually catching the attention of a lot of nations around the world who are shedding U.S. treasuries and in favor of gold, as crazy as that sounds. But what did the BIS call it? Oh, yeah, the only other tier one asset in the world alongside U.S. dollars and U.S. treasuries. So if you want to break reliance on the Western system and on the Western hegemony, well, certainly pricing goods in other currencies for settlement chips away at the settlement of the U.S. dollar. And what did we see last year? 2023, over 20% of all oil sales in other currencies, right? They're chipping away. All of these deals we see settling in other currencies, chipping away. And how about the reserve status? Well, you keep beating up and chipping away at the settlement status, it's going to have effect on the reserve status. But I do honestly believe that a lot of these governments view gold, by looking at its performance over the last 20 plus years, as maybe even a better alternative to treasuries. Now, the one thing they don't have would be that immediate liquidity, but they do. I mean, you have to move it from storage, and that's always why these countries have kept gold at the Bank of England and the New York Fed, because they're the trading humps where they can just move it from one vault or one pile to another and then get paid. But I do think that there is a shift, a gradual shift that most of the dollar bulls don't notice yet. And, I think the dollar milkshake theory has been spot on. I think he's a smart dude, Brent Johnson. I think he's been right. But I think little by little by little by little, logarithmic decay, again, that's my favorite term in so many things I look at around the world, is chipping away not only at the settlement status, but this move to gold, which has held its own against the S&P and bettered supposedly the most liquid, stable market in the world that now has actually less volatility than the 10-year treasury, I think is beginning to take on a different view or a different image with the rest of the world. So I think what that question is something people really need to think about. You do not need to issue a currency with a reserve standard in order to greatly affect the reserve standard of the U.S. dollar. You can issue or trade in local currencies. And especially when you look at all of the countries joining the BRICS, another 30, according to Putin, have formally applied. I thought it was 20. He says 30, and up to another 20 informally. This massive swath of humanity joining this group and settling right now. Remember, that was the deal. We're going to task the finance ministers to go back to the drawing board, come back to the meeting in October in Russia. There's over 200 meetings in Russia this year, all about BRICS. But the big one is in October, where they're going to come back and present their findings. But in the meantime, they're all trading in each other's currencies with one another. Sure, the dollar is still the world reserve. Sure, the dollar is still the emperor who maybe has no clothes. But the point of it is that you are beginning to see the chipping away of the settlement status of the dollar in favor of local currencies. And ultimately, the BRICS could issue not only a common settlement currency or just a decree that if you want to trade with the BRICS nations, it has to either be in gold or in local currencies until we issue a common settlement currency. And maybe someday they issue a reserve currency or a bond market to challenge the West. But in the meantime, I think, and if you look at the numbers, they really don't lie, that gold could indeed represent that hole that would be in place if they shift away from taking the reserves or the excess. That was part of the petro deal. Will you value oil in dollars and take the excess and put it in treasuries? Well, if you remove the treasury aspect and put it into the other tier one asset, gold, with no counterparty liability and breaking free from the Western hegemony as they all want to do, to me, I think that's on the table. That's a playbook that I think you'll see more and more of here in 2024.
The other thing I thought you were going to mention, but didn't. So, folks, if you also want to see a study that was done as far as you mentioned volatility, Andy, of gold having less volatility than the U.S. 10-year Treasury bond in 2023, for people who want to see how gold serves as a anti-correlated asset to offset the risk of both stocks and bonds in a portfolio, whereas people used to rely on bonds to offset the risk of stocks, but that they can no longer do that because they're correlated in the same direction now because of the artificial interest rate environment. There's the Ibbotson study. And folks, if you want to write to us, we'll send you the free copy of that study, a link to it. Just send an email to libertyandfinance@protonmail.com. Just put the word study in the title of the email to libertyandfinance@protonmail.com. We'll send you a link to a document that includes the Ibbotson study that shows that precious metals are the only major asset class that is anti-correlated to stocks, bonds, and so on, so that they are the last remaining bastion of a safe harbor in the face of volatility in those other sectors. And if there's anything we can expect out of 2024, we are told by such observers as Michael Pinto, professional money manager, Rick Rule, commodities investment expert, et cetera, it is volatility ahead for the next 2 years at least. So in choppy seas, you want to know where's my safe harbor. It's not going to be bonds in the current environment. Any further comments you have after? I know you're familiar with the Ibbotson study. Any further comments you have about that?
Yeah, I mean, they are a non-biased research company that was bought by Morningstar. They don't have a dog in the fight, and they show several portfolios, each of them having allocations to gold in various quantities versus those that have none. And in every example, it gave it greater stability and a greater return. And, and that's the point, is that, it's more of a reserve. It's more of a insurance policy. Well, that's what I think a lot of people would consider U.S. Treasuries to be. And that's why I think that there is a good portion of the world that would say, you know what, I don't care. I'm going to look at gold as our treasuries, and we're going to put our excess into gold, which I believe will be part of the new system. I mean, look at Saudi Arabia. Saudi Arabia has over $1 trillion. I think the number is 1.3 trillion in a new, it's a new fund. I don't know how to call it properly, but it's a new, if it's a fund or a sovereign wealth fund or whatever it is, it's a Saudi government program to invest globally in mining. They're going around the world and buying up all they can or investing all they can alongside of China in mining precious metals. And I think there's a lot to be said for precious metals and industrial metals. This is what Zoltan Pozsar said. We are moving into a period of time of transparency in commodities. And so, the Ibbotson study basically said, look, and the Ibbotson study was done more so during a period of time of interest rate suppression. But if we're going back in that direction again, where we're going to lower interest rates and think that the market is not as powerful as the Fed, I think that will be something the Fed will ultimately learn, that the market is more powerful than they are, when ultimately the world says, look, Dunnigan, I can't understand why anyone would be foolish enough to lend the U.S. government money with any length of duration. I understand why people would buy 6-month treasuries or less, paying 5%, certainly better than being in a bank account. Certainly better than having any exposure to the bank if you go to treasurydirect.gov, because if the U.S. government defaults on its loans, we have bigger problems. You'll see banks, cascading. But when you talk about lending money to the government in a 10-year or a 30-year, I think you're out of your mind. Who the hell would do that? And I think that's kind of why we're beginning to see alternatives, perhaps, or the way that the world looks at gold differently, and why you're seeing them accumulated. And when Ibbotson wrote that report, we had interest rates that were, at or near zero or really, really low. And their comment was that it is the only inversely correlated asset to the U.S. stock market. And in many respects, it still is. It's the inversely correlated asset to the Western system. And so I think that it will become more and more and more important to view it that way. And, the big money is always front running. And when you see the most well-informed traders in the world, not only the wealthiest, but the most informed, for 2 years running, buy more gold than at any time in central bank history, if you're not catching this, you're missing something. At the same time, we see great volatility and long tails in the bond market auctions, where there is not enough demand for the 2 and the 10 and the 30-year treasuries that they're selling, unless they continue to jack up the rates. So there will be demand for these treasuries until there isn't, but at some level. Question is, what level will that be? And so this is what I mean about the market being more powerful than the Fed. And, if not, if there is no demand because the rates are not high enough to compensate not only for inflation, not only for default risk, but also for the outright risk of higher rates. The institutional investors are going to demand this. They're going to demand higher return for those three pieces of risk. And if they don't do it, well, who is? The Fed. It's called monetization of assets, monetization of debt. It's called Weimar Republic. All roads lead to the same place. And that's why they're kind of damned if they do and they're damned if they don't. It is an election year. And, the Fed is highly political. It's interesting. Even the people who speak for Jerome Powell said, he was shocked by how just in a period of 2 weeks he changed his tune. Did someone tap him on the shoulder and said, Jerome, there's an election coming up. What are you doing? And so, okay, we'll pivot and we will give in. But all that they are doing, each one of these QEs or these pivotings gets us that much closer to the all at once moment. And to show you how stupid things are right now, we may have talked about this last week or not, I don't know, how desperate they are to keep things hidden from us in terms of how they get money into the system. This new bank funding program that's supposed to sunset in March is allowing banks to borrow money from the Fed at 4.8% and turn around and park it right back with them at 5.3. Well, all of that money liquefying the bank's balance sheets, it's just a joke. It's a complete and total joke that they're allowing this to happen. Or how about the revision? What comes out of the Bureau of Labor Statistics? The Fed does things based upon employment and based upon inflation. Well, we know that they lie to us about inflation, and John Williams of Shadow Stats has done a magnificent job of showing us that. Right now, under the 1980 metrics, inflation's at 10% or greater. Under the revision to 1990, about 8% or greater. Not the 3 or 4 they're telling us. But the BLS, we should usurp the L and just call it BS because they constantly lie. Quietly, they just revised the payroll data from 2023. Most people missed that, but the total revision of 2023 was 443,000 jobs, or 40% of all the payroll growth. Oops, the birth-death model was wrong. We're revising it downward by 443,000 after we already based all of our decision-making supposedly upon these numbers. We're being lied to. They were wrong in 2008 when they said the subprime crisis was contained, and a few days later it blew up. They were wrong when they said there was no inflation, and then it was transitory, and then it was structural, and then it was on its way down, and now we've engineered a soft landing. They lie continuously. And I think that people need to understand that this is not a country that inspires confidence. And I think the big money around the world understands that. And this is why you are seeing them sell bonds and buy gold, because it is wealth. And when people say, who's going to trust China and Russia? Who the hell trusts us anymore? Or the Bureau of Labor Statistics, or the current administration, or any of this stuff that is less than forthright. And I think now it's creeping into people's psyche regarding the 2024 election. Is it going to be fair? Is the Justice Department fair? All of these things are happening coincidental. They're all coming together at the same time. And I think it's important to realize when we talk about the bond market and the rest of the world's appetite for holding our debt, a country that's losing confidence globally, that, maybe just maybe this recency bias of the last 50 years needs to be reevaluated. I think you're seeing a lot of the countries do just that.
The other thing you've mentioned in the past that bears restating here in this part of the discussion, you just mentioned who in their right mind would lend money to the U.S. government for 10 to 30 years in the current environment of volatility, of deception, and that sort of thing, destruction of the currency, et cetera. It's worth mentioning that since 2008 financial crisis, which led to the Dodd-Frank Act, which when it was passed in 2009 and went into effect in 2010, called the Consumer Protection and Banking Act or whatever, which is like everything else that comes out of Washington, named the exact opposite of what it does, means that nothing in the banks belongs to you. And then we just got this book that came out about 2 months ago called The Great Taking. And we can put a link to that in the description of this video. If you haven't skimmed it, at least you should. That basically will convince you that nothing that you own, that nothing in the brokerage account, in none of your stock certificates, shares, that sort of thing, or deposits you have in your brokerage certificate belong to you either. So if nothing in the bank belongs to you and nothing in the stock market belongs to you, that might have another thing to describe why countries around the world who aren't intoxicated, who aren't drinking the Kool-Aid of the Western system that's based on a house of cards of lies, are in fact holding on to things that are real.
Well, and I'm glad you brought that up. So listen to this. I wrote this down also because I think people need to understand it. It's one thing for me to always say that you're an unsecured general creditor of the bank under the Dodd-Frank Act and you can get bailed in. Let me read it to you. Bail-ins. Under Dodd-Frank, as receiver, the FDIC would have 3 to 5 years to liquidate the bank. And so 3 to 5 years, right? Bank gets bailed in 3 to 5 years to ensure that the shareholders and the uninsured creditors, that's the depositors, bear the losses of the failed bank. So 3 to 5 years to ensure that the shareholders and the uninsured creditors or depositors bear the losses of the failed bank, that's you, remove bank management responsible for the failure. Well, maybe it's the FDI or the Federal Reserve that should bear some of that responsibility, but I digress, and make payouts to the claimants that are at least equal to the amount they would have received under bankruptcy, covering FDIC insurance liability to qualified depositors for up to $250,000. So that comes right from the Dodd-Frank Act. They have 3 to 5 years to pay you $250,000 when you had $2 million in the bank. So you might get $250,000 within 3 to 5 years, God willing. The point is that these are not things that are made up. This is real. And when you read the David Rogers Webb book or go to YouTube and Google it, he actually narrates this hour-long YouTube. It's terrifying, and people don't believe it, but it's true, and it has a lot to do with the way that changes have been made under custodial ownership and beneficial ownership. You need to listen to it and read it. I think you'll see that it's setting up so that many of the things that people feel they own outright, actually they do not own. And this is why we talk about gold being assets that are not simultaneously someone else's liability. It's very, very true. When you talk about the banks, U.S. office buildings have $117 billion that come due here in 2024 to be refinanced or reset. And, you know, how's that going to happen at rates that have gone much higher? And as the economy is slowing down, businesses can't afford it. You're going to see bankruptcies, small business bankruptcies in particular, as the small business is being squeezed, and commercial real estate problems. All of it, 70% of both the small business loans and leases and the commercial real estate loans and leases are handled by the small and regional banks. It's a time bomb waiting to happen. And the first one, I think, that gets bailed in will set a fuse that will freak people out to no level. I think people will go running and it will set off a chain reaction. So, you know, could there be a recession? On top of all of this, you know, the current deficits that are running are deficits that are running $2 trillion a year. We have $10 trillion in bond payments due this year. How the hell are they going to pay for that? Oh, I know, we'll borrow more money. And so we're borrowing money to pay our current obligations, where we spent $900 billion on interest payments last year. $900 billion. And we've talked about by 2031, 100% of all the tax revenues will be go to use just pay the interest on the debt and mandatory entitlements like Social Security. And that means everything else that will be discretionary, including military spending, will need to be borrowed. Everything. So it creates a very, very, very big problem. And that doesn't take into account, how about the 10 million people who have entered this country illegally that we're now finding a way to give medical care to, and a cell phone and a driver's license, and who's going to pay for these people? The housing allocations, the medical needs, the labor market competition, which will lower the labor the price or the wages for tax-paying Americans, and the education system. Where's all this money going to come from? So maybe 2031 is 2029, 2030, who knows? The point of it is that look, we reached 30 We reached a milestone the last day of the year, 2023, of $34 trillion owed. But if you go back 1 year earlier, January 1, 2023, the debt was $31.4 trillion. In one calendar year, we added $2.6 trillion. And I mean, that's just insanity. It took over 230 years for us to do the first 2.1 trillion. Now we're doing it in a year, and we're issuing $1 trillion in debt every quarter. The acceleration at the end of any system, it begins to massively increase, and we are at that point right now. This is why you're seeing the world buy gold, and they are using the suppression of it to keep us all out of the loop. And I think the people running this government exhibit such arrogance and incompetence, where equity is more important than quality and character. All of these things, including the mismanagement of the currency and the weaponizing of the dollar, is why we are where we are. And I don't think it gets better. God help us if we don't see some sort of a change in 2024 with people running this country. Because, I think it's, look, now you got JP Morgan coming out and saying the $34 trillion debt is a boiling frog. Really? It's interesting that JP Morgan would say that. Of course it is. But it's something that's not going away anytime soon. And, look at the countries joining BRICS. They're the ones that possess all the commodities, all the energy, all the strategic trade routes. And it is a trend that is accelerating, with 30 countries formally applying and another 20 informally. By this time next year, it'll be a different world. And I'm very convinced of that, Dunnigan. I truly, truly am. And so people can say what they want about saying the same thing or talking my book. If you can't see from when we started talking about this 3 years ago to where we are now, the massive expansion in everything we've talked about, and it freaks me out how I did get this right. But I don't think we've seen anything yet. Or that all at once moment. That maybe be 2024, maybe not, but it's coming.
Yeah, what you describe is a coming crisis. And we've talked about coming volatility, increasing volatility. That's what we're told to expect. But that's what happens when you're approaching the end. You said the end of a system. That's a good way to put it. That's also the end of an exponential function. You start to just get these runaway oscillations because when you're coming up against a hard barrier which you can't pass, you simply can't go to infinity or zero, you start to get these incredible violent whipsaw oscillations near a boundary condition. And in the face of that, you see prudent, observant, wise, shrewd individuals, families, countries positioning themselves as you normally would, as a rational being would, facing a coming crisis, a looming crisis. You take appropriate action. And so we talked about nothing in the bank is yours. We talked about nothing in the brokerage account is yours. That now let's take it a little closer to home. Australian economist John Adams, who we've interviewed several times on our channel, talks about what do you actually own? What do you actually have legal title to? And unfortunately, many people who have intended to do the right thing, for example, putting their savings into precious metals IRAs or that sort of thing, or even just owning precious metals and holding them in certain vaults, believe that they have done the right thing because they've understood the relative virtues of owning real assets. But then ironically, whether it was through ignorance or conniving on the part of the people that sold them, some of these storage accounts, for example, and some of these vaults are pooled, commingled, non-allocated, non-segregated, that sort of thing. So when John Adams asks, if you're an owner of precious metals, what do you actually own? What do you actually have legal title to? Can you touch on that before we wrap? Is the importance of making sure that you either hold it yourself or that it be in a segregated, allocated, and audited account?
Yeah, I mean, it's huge. And there are a lot of companies out there that sell allocated accounts, which is pooled. Segregated is not. Allocated to the pooled program, segregated to Dunnigan. That's what you want. And, you want it definitely 100% segregated in your name. And, I listened to Rick Rule once talk about storage facilities, and he made a good point that I really understand now after seeing what happened to First State Depository and this idiot who stole all this money. And he talked about storage programs or companies that have very large balance sheets like Brinks, where the metal that they're storing doesn't make or break their ability to stay in business, where you have the ability to go retrieve it, where you know where it's at, where it's completely segregated and audited. Those are the things that you can do to the best you can do, hoping for the best, preparing for the worst type of thing. And I think they're valid, very valid. But a pooled account, because it's cheaper, or there are some certificate accounts like the Perth Mint where storage is free. Well, I'm not speaking negatively about the Perth Mint. They've been very good to me. John Adams has shed enough light on their failings, but I will tell you that any time that you can get something for free, you should think about it. Now, again, I am not casting any disparaging light on the Perth Mint or their Perth Mint certificate program, but as someone who's run a storage program for almost 20 years, I get nervous if someone says, yeah, my metal's stored for free. Well, it's not segregated, number one. It's pooled or allocated. You have a right to it. And the fact that it's free storage tells me it's not really yours. I mean, it is, but is it? How do you get it if you need it? And when you talk about anything, I think being penny wise and pound foolish in anything is very dangerous, especially in things like gold and silver. So that's why, as the person who signs each one of these storage contracts, where we've delivered between $200 and $300 million worth of product to Brinks around the globe over the last several years, I want to work with a company where my butt's on the line, that I know is legitimate, is regimented, has a very large balance sheet, where people know where it's stored, have the ability to retrieve it, and it's completely segregated and audited. That gives me peace of mind. If any of those things are incomplete, I wouldn't do it myself. Doesn't mean they're not good companies. Doesn't mean that they're dishonest. It means that there are too many potential pitfalls. And in a world where the statement, you don't hold it, you don't own it, there's legitimacy to that, I guess. But I'm very proud of the storage program that we built. And I've spent many, many, many hours and traveled many miles to all of the Brinks facilities to make sure of just that. And in all of the years I've worked with them, I've never seen an ounce out of place or got angry with them. But that still, in a world that I think will look at the phrase counterparty risk very differently in the coming years, if you're going to trust someone to it being stored, do not be penny wise and pound foolish. Do not accept anything else besides segregation. Make sure you have the ability to retrieve it if you want, know where it's stored, and work with a company with a track record like Loomis or Brinks or IDS. Any of these larger companies would be the ones that I would recommend off the top of my head if you're going to leave it there for an extended period of time. And the only other thing that comes to mind is that when I look back at a company like Bullion Direct in Austin, Texas, who stole $35 million in gold that they were storing for people in their own facility, I don't like that either. I'm not saying that every company that has a vault on premises that stores on behalf of clients is illegitimate. But I am saying that, again, when I'm signing everything, I would rather have a third-party entity like Brinks being responsible for everything and take all of that, even the perception of risk based upon our company doing impropriety transactions that are inappropriate. Or I'm trying to say that. I take it completely out of the equation, and that's why I choose having a third-party entity, a wall, if you will, between who sold it to you and who's holding it for you, because in some cases we've seen conflicts of interest. So it's a good question. It's one that people should give thought to. My answer would be hold as much of it as you can until you lose sleep at night, and then pick an establishment like our Brinks program, which is done, I think, with these things in mind. Giving you the greatest peace of mind and the least amount of risk and the greatest amount of segregation and the ability to retrieve it, all of those things with a Fortune 100 company. So, to me, that's the best we can do, hoping for the best and preparing the best we can for any potential pitfall that we've tried to address. So good question, and one that I think about a lot.
Well, Andy, thank you for joining us again. Folks, remember, if you want to get a copy of the Ibbotson study about asset class correlations, make sure you email us at libertyandfinance@protonmail.com. Make sure you put the word study in the title of the email, and we'll send you a link to that. And Andy, as always, thank you for joining us for these weekly market updates on Liberty and Finance.
Best to you and your family. Congratulations on the new addition to the family, and blessings to you all. Happy, healthy New Year to everyone. Dunnigan, I look forward, as always, to picking up where we left off next week, and safe travels back home, my friend.
Thank you, Andy.
Yep, stay well.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin weekly specials for January 8th through January 15th, 2024, while supplies last. First this week, we feature backdated 1/4 ounce gold eagles at just $65 over melt. Next, the Armenian 1 ounce silver Noah's Ark coin is $3.49 over spot. And finally, we have a very limited quantity of 1 ounce silver Trump Wanted bars at $3.15 over spot. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.